Hey guys, we're going to be doing a weekly podcast starting this week. We've got Ben here, who's going to be talking to us about interest rates, loans, and what's going on in the marketplace right now. And Sebastian, would you want to take over?
Yeah, so like Shane said, this is Ben, our preferred lender, the one we love to work with. He's been in the industry for years, very informative guy, very knowledgeable, and he is here with us as a special guest for any questions that we may have as home buyers, and for some of us, even first-time home buyers. So welcome, Ben.
Thanks for having me. I appreciate it. Love you and your team. So
Thanks for joining us. So go ahead, start out.
So a lot of misconceptions about interest rates and things like that. Let's talk about what it takes to get a loan. So first of all, when you get a loan, where do you borrow that money from? Fannie and Freddie Mac is what they're called, and they're kind of like the rich grandparents that everyone needs in their lives to basically get them, the federal government they loan money to lenders and then they back it up. So they're the kind of the people that make the rules with regards to lending when you do conventional FHA, VA, or whatever type of loan that you get into and things like that. So with that being said, they introduced some new rules when it comes down to lending, and one of the things that they actually take into account now that they didn't before it's called debt to income. Now, what's debt to income, Ben? Well, debt to income is basically when you take your whole salary or your gross salary and your debts, including the new mortgage that you're going to get, are leveraged against that. They don't want you to get into a house where you're struggling to pay your gas bill and you're struggling to pay for food for your kids. So they don't let you go above a certain amount, just depending on the loan program that you have. And that's what debt to income ratio is.
Can I ask you a question about debt to income?
Yeah.
Do they take your income from your tax return after your deductibles, or?
Good question. So they do take the money that you pay taxes on. That's a common misconception with people that are self-employed. Yeah. I'm all about writing off things when you're self-employed, writing off, but what we can take as far as your income is what you pay taxes on versus what you make on paper.
So it's probably good advice to someone that if they're getting ready to purchase a house that they are self-employed.
Correct.
That maybe they don't want to take as many deductions, so they don't have to.
Absolutely, we want to maximize your income, and you need to work with your tax professional to do that for sure, because they know a lot more about that than I do. But at the same time, you want to maximize that. Because the debt to income ratio now, because Fannie and Freddie made this change, it now has an effect on your interest rate, whereas before it did not. So that's why you want your income to be high and your payments to be low, like your car payment. Now, one thing it doesn't take into account, or it doesn't calculate, like your cell phone payment, your gas bill, those are not included in your DTI. It's only your fixed payments, like your credit cards, your cars, your homes if you own another home or anything. Those are the things that are taken into account for your debt.
So the things people need to be ready for is the debt to income as well as the credit score, so that they can get the best possible interest rate.
Right, and credit score is definitely important. It's an important part. There's lots of different tools to help people that have challenging credit. I'm more than happy to take calls. I love helping people that just have some challenging credit to help them get their credit scores up. Credit has a big factor in that too. And it used to be that 760 was the high credit score. That's the best credit you could have, was north of 760. They changed that, Fannie and Freddie did, to 780 now. So it needs to be 780 or above. Again, lots of different tactics and different situations, and I get it. That's unfortunately that's the rules they changed too.
Do you ever see people improve their credit scores by like 100 points? Maybe somebody was in the 680, still not horrible, but then getting it to 780. Do you ever see people?
Yeah, we do. We actually do. We see people improve it quite a bit by some of the different strategies we use. We don't necessarily want you to go to a credit repair place. That's not to say they're not great. I'm just saying there's different strategies that we can do just off without paying somebody, because I want to save you money, save them money. The best way is to become what's called an authorized user on somebody's credit account. So credit is definitely, it's based on a few things. The length of your credit, the amount of the credit that you owe, and then the length of the credit, the amount of the credit you owe, and then the oh geez, why am I drawing a blank here? We can edit this. Your payment history. Your payment history. So your payment history and things like that. So the amount of credit you have. So a good way to increase someone's credit score is actually by taking somebody who has a large credit card that they pay off every month, like your spouse or even a sibling or parents, and actually putting them as an authorized user on that, because they can almost adopt their credit score. So if you want to build your kids' credit scores, put them as an authorized user on your credit card, as long as you're paying off that credit card every month, or at minimum keeping the balance between 10% and 30% of what it needs to be.
Yeah, I just wanted to add that, like, growing up, my grandma did that, and now I have a 780 credit score. That benefits me so much because, like, if I was to go get a loan or something like that, I'm gonna get the lower prices.
Yeah, I have my kids on as an authorized user on my car, and a lot of people are nervous about that. Well, I mean, he's going to have access to my credit. You don't even actually have to have the person doesn't have to have the credit card.
No.
You can put it in a safe and keep them there, and then they slowly build their credit. But as you do that, you want to get your own credit card as well. So you start building your credit eventually to where you have a 780 credit score on your own. Because it's about the length of the credit too. So if your parents or your spouse, significant other, whatever, kids, if they have a 15-year credit card they've had for 15 years, and then you actually become an authorized user on that, it looks like, from the credit bureaus, because we're tricking the credit bureaus. It looks from the credit bureau's perspective, you're actually looks like you have a 15-year debt that's been open for 15 years, which is really favorable, just as long as they're paying it off. If it's got if it's got a $15,000 balance and then they're using $15,000 of it, then that can negatively do the opposite.
Well, that's why you get someone you trust. Someone that's responsible, that pays their credit cards and things like that.
Yeah. So building credit is I love that. I love helping people that just don't understand, and it's great because we just helping people like understand what goes on in the process of a mortgage and how they can get a better score, how they can get better rates. There's lots. It's just I enjoy that challenge, not necessarily just because we're going to get a loan right away from it, but more so because we're helping somebody achieve the American dream of getting a home.
I like that.
And that's so.
Well, go ahead.
Thank you, Ben Shoff. He's with Fairway Mortgage. And we really appreciate you taking the time to explain some of these. We're going to have another video next week.
And if you have any questions, put them in the comments.
Yep.
Thanks.
Thanks.
Bye.
Thank you.
Bye.
Thank you.